Hi, I'm Joey. Today, learn what is the 930 trading strategy that successful traders want to hide it from you. Through this power of trading, we're going to share the 930 trading setup, which is based on a simple moving average trading strategy. Additionally, the 9 and 30 EMA trading strategy will teach you how to trade pullbacks and ride the trend. If this is your first time on our channel, our team at the Power of Trading welcomes you. Make sure you hit the subscribe button, so you get your free trading strategy every week directly into your notification box. Traders and investors usually pay close attention to key moving averages, 9MA, 20MA, 30MA, 50MA, 100MA and 200MA. Most popular financial shows on Bloomberg TV and CNBC will often make reference when the stock prices or major stock indices get near these moving averages. What is the 930 trading setup? Originally, the 930 trading setup was developed by Mike Burns, and involves using a combination of two moving averages. 9-period exponential moving average, EMA. 30 periods weighted moving average, WMA. In this case, the 9 EMA is our short-term moving average, while the 30 EMA is out long-term moving average. The 9 and 30 EMA trading strategy seeks to take advantage of the blank space created between the two moving averages. The filter for the 930 trading setup can be summarized into a three-step process. These are the rules for a long trade signal. 9-period EMA must be above the 30 periods, WMA. The two moving averages need to be apart from each other, see chart. The first bar that closes below the 9 EMA will be used as the trigger bar for the buy setup. Place a buy limit order above the high of the trigger bar. Note, the bar that closes below the 9 EMA needs to remain above the 30 WMA for this setup to be valid. If you want to go short, then you need to follow this three-step process. 9-period EMA must be below the 30 periods WMA. The two moving averages need to be apart from each other, see chart. The first bar that closes above the 9 EMA will be used as the trigger bar for the sell setup. Place a sell limit order below the low of the trigger bar. See a short trade example. Like with many trading strategies we present, you can always use different flavors to get into a trade. So, you can also use chart patterns to fine-tune your entry. Moving on. In order for a strategy to be completed, we need to also define how to manage the trading risk. In other words, we need to define a place to hide our protective stop loss and an exit strategy. How to trade with the 930 EMA strategy. In this section, we're going to teach you how to effectively trade with the 930 EMA strategy. No matter how simple this trading strategy is, you need to have a set of trading rules before you use it. So, let's talk about the stop loss and take profit strategy. For the stop loss strategy, you can use the trigger bar, high/low for reference. For example, if you have a buy trade signal, you hide your protective stop loss below the low of the trigger bar. Alternatively, for a more conservative approach, you can hide your protective stop loss below the 30 periods WMA. See the Forex chart. Here's a little bit of trading wisdom from hedge fund billionaire Bruce Kovner. Place your stops at a point that, if reached, will reasonably indicate that the trade is wrong, not at a point determined primarily by the maximum dollar amount you are willing to lose. Please note that the lower the time frame used, the more price whipsaws you're going to experience. As a trading trick to avoid being caught in a whipsaw trade, make sure you add an extra buffer to your stop loss. This buffer will allow your stop loss to survive during false breakouts. Moving on. It's easy to exit these types of trades via a trailing stop loss below the 30 WMA. This exit moving average strategy has two benefits. You don't have to guess a possible take profit level. You got to keep riding the trend until a reversal happens. See the Forex chart. Let's see what type of trading environment is best suitable with the 930 moving average trading strategy. When to use the 930 trading method. The 930 trading method is a type of trend-following strategy that seeks to enter the trade on pullbacks. In this regard, the best time to use the 930 trading strategy is when we have established a trend. The trend can be defined via the two moving averages as follows. The bullish trend is defined when the 9 EMA is above the 30 WMA. The bearish trend is defined when the 9 EMA is below the 30 WMA. The strength of the trend can also be measured via the space created between the two moving averages and the angle of the moving averages. The bigger the gap between the 9 EMA and 30 WMA and the steeper the angle of the two moving averages, the stronger the trend is. Conversely, the flatter the two moving averages are, the weaker the trend is. In and of itself, the trigger bar used to enter our trades doesn't give us a trading edge. The edge comes from trading in the direction of the prevailing trend. After you have a moving average crossover, and a strong trend emerges from it, that's when you want to use this strategy. Note: avoid using the 930 trading setup in flat markets. Moving forward, we'll teach you how to implement more advanced trading concepts, along with the 9 and 30 EMA trading strategy. 9 and 30 EMA trading strategy - advanced concepts. The 9 and 30 moving average strategy is a versatile trading strategy that can be used in ways you never thought possible. You can use this method for short-term trading, medium-term trading, and long-term trading. It all depends on your preferred time frame. Now, here is a powerful trading secret about the types of moving averages used in this strategy. The combination of the exponential moving average and the weighted moving average gives us a wider spread between the two EMAs. This is a key principle that makes this EMA strategy work. Now, you might wonder, how can we improve the 9 and 30 EMA trading strategy? If we add a better entry filter, we can gain an extra edge. What do we mean by this? Instead of using a bar that closes above/below the 9-period EMA, we can wait for the entire bar to be encompassed between the 9 EMA and 30 WMA. However, the downside to this trading approach is that you will get fewer trading setups. See the 4x chart. Oftentimes this type of trading setup can lead to explosive trades that never look back. What are other ways to use the 930 trading setup? As we explained earlier, the edge of this pattern relays on the resumption of the trend. So, what's the simplest way to measure the trend direction? A series of higher high followed by a series of higher lows defines an uptrend. In reverse, a series of lower highs followed by a series of lower lows define a downtrend. So, we want to look for ways to capture these types of price structures. To do this, we're going to introduce the concept of multi-time frame analysis. Check out here simple trading tactics to multi-time frame analysis. Note: the advanced 930 trading setup works best in conjunction with the daily chart. To better time our entries, we're going to a combination of two time frames as follows. The daily chart to spot the trigger candle that closes above/below the 9 EMA. Downgrade the DF to 15 minutes or 5 minutes and look for uptrend and downtrend price structures. If you haven't realized, here is the main reason why we use this approach. We know that the daily range can be quite high. So, instead of using the high of the daily candle to trigger our entry, we downgrade our chart and seek, on lower time frames, early signs of upward/downward price structures. Secondly, this trading approach also reduces the stop loss needed for the daily candle. Here is an example. See the US dollar to Canadian dollar daily chart. Based on the 930 trading strategy, we need to wait for the daily candle low to be tagged to trigger an entry. However, with this new advanced concept, we can enter the market early and capture more pips. When we downgrade to the 5-minute chart, we can notice the pattern of lower highs and lower lows signaling the start of a downtrend. See the 5-minute chart. Keeping in mind the chart setup found on the daily time frame, we can make a trade on the 5-minute chart when price breaks and forms a new lower low. When the price makes a new lower low, after at least two lower highs, it develops the price structure of a downtrend. This makes an excellent entry method for the 9 and 30 EMA trading strategy. Final words: 930 trading strategy. In summary, the 930 trading setup is a very effective trading strategy to be used across all markets and timeframes. Keep in mind that the power of the 930 trading strategy comes from having a prior upwards, downwards trend. Traders should use this method as a pullback trading strategy, rather than try to find reversals. The key takeaways from the 9 and 30 EMA trading strategy can be summarized below. You have the momentum power of the prevailing trend on your side. You only need to focus on the gap between the two moving averages. Offers you effective ways to manage your risk. Built-in trailing stop. Versatility to be used in conjunction with other trading methods. Last but not least, make sure you use effective money management strategies and position size to protect your capital. After all, your number one priority as a trader is to protect your account balance at all cost. Thank you for watching. Feel free to leave any comments below. We do read them all and will respond. Also, please give this strategy a 1 like if you enjoyed it.
Press the bell icon on the YouTube app and never miss another update.